Hello everyone, welcome to Brilliant Bankers. In today's session, we will be discussing about the components of assets and liabilities in a bank's balance sheet and their management, wherein we will be going through a detailed study on the components of the assets and liabilities in a bank's balance sheet, the management, the significance, and the purpose of the asset liability management in a bank. So, coming to the components of a balance sheet. A balance sheet has two sides, that's the liabilities and the assets. So, assets and liabilities are terms that are commonly used to describe the property and the items that are either owned or owed. The items that are owned are called the assets, and the items that are owed are called the liabilities. That is something that we have to return to someone is called liabilities. So, this can be from a personal or a business viewpoint. So, assets are the things that a business or a person owns and that are valuable to him. So personal assets may include the cars, the houses, while business assets include the equipments and the lands. While liabilities are the things that a business or an individual owes to other business or an individual, such as the debt and the bills. Assets and liabilities are usually calculated together to determine the overall value or worth of the business or the concern or also of a person's routine. So coming to the liabilities and assets, what are the different type of liabilities and what are the different type of assets which are part of the balance sheet? The liabilities are the current liabilities and the non-current liabilities. And coming to the case of assets, it is the current assets and the long-term assets. Now let's go into the liabilities in detail to have a basic knowledge of the components of a balance sheet. Now we are not talking about the bank's balance sheet. We are talking about a common balance sheet that is being used in a accounts or in any industry. Coming to the topic of liabilities, what are the things that comes in liabilities? So this section of the balance sheet shows the money that the company owes to others, like the loan expenses, the recurring expenses, and other forms of debt, etc. Now, the liabilities can be divided into the current liabilities and the non-current liabilities. So, what is a current liability? A current liability is anything payable and is due in that particular year, like any maturities of a long term. So, if there is rent to be paid, anything that is due, the telephone bills, the electricity bill, everything that is due in that period is called a current liability. Any debts that is to be cleared in that financial year is called a current liability. And the accounts payable, that is to the bills payable to any person, is called a current liability. What is a non-current liability? These are the deferred tax liabilities which are carried forward to the next financial year. The bonds payable, the long-term debts, the debt that does not finish off in this year itself, for which it keeps on going for the next financial year also. And anything payable in long term and not maturing in this financial year is called a non-current liability. The same is the case of assets. Asset is also divided into two parts. There is a current asset and the long-term assets. In this session, the current assets, the assets that can be converted easily into cash within a year or less are called the current assets. These are the following divisions, something like the prepaid assets, the items of value for which the company has already made a payment, like business insurance, the office rent, etc. All these things. The inventory of the business, like that of the raw materials, finished products, etc. Any accounts receivable, that is the money that the company's client owe from services that has been rendered in the payable in short term. All these marketable securities, that is the investments that a business can sell off within a year, and the cash and the equivalence that is held by the business in hand and in bank. So any money saved in the firm's savings account or the current account or any cash held in hand are called the current assets. What are long-term assets? Those assets that cannot be converted into cash within a year are called the long-term assets. like the fixed assets, in which you can take the buildings and properties. In intangible assets, like the patents, the copyrights, and the franchisee agreements, and all these things. What is a long-term securities? Long-term securities are investments that a company cannot sell within a year. So now let's go into the components of a bank's balance sheet. In a bank's balance sheet, assets and liabilities can be classified depending on their length and factors. In this kind, the liabilities of a bank are also called the sources of fund, wherein the different type of liabilities of a bank are the capital, the reserves and surplus, the deposits of the customers, and the borrowings and other liabilities and provisions. So how come these are called the liabilities? What is a capital? A capital is an investment made by someone for the bank, which is to be returned on one particular day. So this is calculated as a capital. Sorry, this is calculated as a liability of the bank. In the case of the reserve and the surpluses, which is being held at the bank, is a liability. The deposits that has been taken from the customers is always a liability for the bank, because any day just be returned back to the customers. And any borrowings the bank has taken from RBI is called the liability. Coming to the next point, there is the assets of a bank. Assets of the bank are also called the uses of the bank. So different type of assets of the bank are the cash and balances that is held with RBI and in hand. That is, this asset item includes all the cash in hand and the cash held with RBI. That is including the foreign currency notes and the cash balances in the overseas branches of the bank. Any balance that is held with RBI includes the balances held by each bank in order to meet the statutory cash reserve ratio, and also the surplus cash that has been parked with RBI over and above the CRR requirement. The balances of the bank and any money at call and short notice are also included in this cash and balances held with the RBI and in hand. What are the investments? Any major investment or any major asset item in a balance sheet of a bank is called an investment. That is in various kind of securities. These includes the investment in government securities, approved securities by the RBI, that is like the shares, debentures, and the bonds that has been approved. And banks also invest in various government and other securities as a part of their compliance to the SLR, that is a statutory liquidity ratio, as mentioned by the Reserve Bank. What are the advances? The most important asset item of a bank's balance sheet is the advances. These advances represent the credit extended by the bank to its customers, and it forms a major part of the assets for all the banks, thereby becoming the major source of income of the bank, like that of the cash credits, the overdrafts, and the loans that are repayable on demand. There are term loans, and also the bills purchased and discounted are also asset for the bank. Coming to the fixed assets and the other assets, all the fixed assets of the bank, there is any immovable property or the premises, the furniture and fixtures, the hardware that is being held in the bank, all motor vehicles that are used by the bank and owned by the bank. These are all the assets of the bank. So coming to a detailed components, we also have a profit and loss ledger or a profit and loss account of the bank. So what does a profit and loss account of a bank show? It has two heads, that is the income and expenditure head, which we call as the income and the expenses. The income, a bank's profit and loss account has two common heads, that is the income and the expenses. The income, which includes all the interest income and other income. Expenses includes all the interest that has been expended and the operating charges and the provisions and contingencies that are happening in the bank. What is the interest income? The income, a bank's income is broadly classified as interest income and other incomes. So coming to a detailed breakup, coming to the interest income, it forms a major and the most important revenue for a bank. The bank thrives on this income as spreads are essentially generated out of this income. These incomes are from the interest or the discount on advances and the bills or bills. The other thing is from the income on the investments that has been done by the bank, and also from interest on balances that are being held with the RBI and other banks, or other intra-bank funds that has been held by the bank. So from all these things, what does a bank get? They get some kind of interest, and also they get an income on the discounting of the bills. So these are the ways of a income. What are the other incomes that are being benefited by the bank? The other incomes are the commissions, that is the exchange and brokerage, the profit on the sale or investment, the profit on the revaluation of their assets, the profit on the sale of land, the building, or any other assets that are being held by the bank, and also the income that is earned by the way of dividends. This is by the dividends from the subsidiaries or companies, or from the joint ventures that the bank has mingled in India or abroad. So these are the different type of incomes by the bank. That is the interest income and the other income. All incomes of a bank are divided into two parts. That is the interest income and the other income. Interest income defines all income that is from the interest from deposits in other bank, interest from the advances given to customers, the profit that they gain on the discounting of the bills are the interest income, and the other income is the income from the commissions, exchange and brokerages, on the profit on the sale of their investments, and the profit on sale of their assets, and different income that has been earned on the dividends in their investments. So what are the expenses? The expenses of a bank can be broadly classified into the interest expenses, the operating expenses, and the provisions and the contingencies. So what is the interest expense? Since they have to mobilize the funds regularly to meet the credit demands of the customers, the major expense of a bank arises from the interest expenses that is expended on the deposits and the borrowings of the bank. Automatically, when there is a deposit, the bank has to give some interest for the depositor or the customer. In that case, the expense of a bank is an interest expense. So income was also interest income. In this case, the expense is also interest, and also on the interest on the borrowings from RBI or any other bank. What are the operating expenses of a bank? The operating expenses of a bank generally include the cost of running of the bank, like the provisions to the employees, the rent, the salary that is to be paid to the employees, the expenditure on the printing and stationery, on advertisements and publicity, on the depreciations of their property, on issuance of the directors' fees, like the and other things like the law charges, the legal charges that are being paid by the bank, the expenditure on postage, etc., on insurance work, extra. What is the provisions and the contingencies? This is one of the biggest expenditure account of the bank, wherein the provisions made for the bad and doubtful debts, and the taxation, the diminution of the value of the investments that is due to what? Whenever there is a diminishing in the value of the investment, means there is some kind of depreciation happening on the assets, that is diminishing the value of investments. The transfer of contingencies and other similar items that appear under the category of the expenses. So these are the income and expenditure that come in a profit and loss account of a bank. So coming, why have we been going through this balance sheet? Automatically, this balance sheet is what we are learning or what we are using in a ALM, that is the asset and liability management. So what is an ALM? ALM is a strategic management process that helps the financial institutions align their assets and liabilities to optimize the risk, profitability, and liquidity. That is, ALM is like a financial balancing act for the banks, and the financial institutions. It's about making sure that the right mix of investments, that is the assets, and the funding sources, that is the liabilities, to make the risk or manage the risk and ensure profitability and stay stable even when the economic conditions are changing. So this is where the ALM has its play. So what are the parts of an ALM, or what are the things that are there in a ALM? It's like the assets, the liabilities, and the risk management tools. Coming to the assets, what is an asset? Now we have already gone through it. So we are, I don't think we have to explain it again. So it is the assets, the liabilities, and the management, risk management tools. The risk management tools come in the case of the interest rate risk, the liquidity risk, and the regulatory compliance. Whenever there is an interest rate change, it affects how much the bank pays or earns on loans and how it pays on the deposits. In this condition, the ALM helps the bank manage the interest rate risk. And ALM again helps the bank to ensure that it has enough cash or liquid assets to meet any crisis. In case if there is a withdrawal of money from the bank in any sudden case, it also helps in the regulatory compliance by following the rules set by the regulators. For example, there are guidelines about how much of the bank's fund should be in a different type of assets to maintain a healthy financial position. And what are the processes that are being carried for that? It is the identification of the risk, setting objectives, the strategy formulation for the same, implementation of strategies that has been formulated, and monitoring and reporting of all these strategies. This is the process that is carried forward in a ALM by a ALCO, that is the Asset Liability Committee. Coming to the significance of an ALM. So, what are the significance of an ALM? Here we have already learned that it plays a crucial role in the banking and financial sector, serving as a strategic framework for managing the various risks and optimizing the balances between the assets and liabilities. So there are several factors that contribute to the growing significance of the ALM in this sector. This is used to adjust the interest rate risk and the liquidity risk that is being happening in the, or that happens in the banking industry or the financial institution. So what are the points that are to be taken care of? It is the volatility. In this case, the financial markets are inherently volatile, subject to the sudden changes in the interest rates, exchange rates, and other economic factors. Here, the ALM helps financial institutions anticipate and manage the impact of market fluctuations on their assets and liabilities, ensuring that they remain resilient in the face of a changing economic condition. By product innovation, ALM helps the financial industry continually introducing new products and services to meet the evolving customers' demand, wherein ALM is crucial in assessing the risk associated with these innovations, helping the institutions understand how new products may impact their overall balance sheet and the financial stability. What is a regulatory environment in the case of the significance of an ALM? Regulatory bodies impose stringent requirements on the financial institutions to maintain the stability and protect the depositors. Here, the ALM enables banks to comply with the regulatory guidelines by ensuring that their assets and liabilities are appropriately aligned, minimizing the risk of insolvency or the liquidity crisis. Coming to the case of the embedded options in assets and liabilities, financial instruments often come with embedded options such as the call or the put option, which can impact the cash flow and create uncertainties. Here, the ALM helps the institutions model and manage the risk associated with the embedded options, ensuring that they are adequately compensated for the risk they assume, and also by the management recognition. The complexity and the interconnectedness of financial markets has led to the increased recognition of the importance of strategic balance sheet management, wherein the ALM provides a structured approach for management to access, monitor, and to make informed decisions about the composition of the assets and the liabilities of a financial institution by aligning them with the institution's risk tolerance and the strategic objectives. All in all, the growing significance of the ALM in the banking and financial sector is driven by the need of a or need to navigate a dynamic and a complex environment. So it enables the institutions to proactively manage risk, capitalize on the opportunities that are being provided, and to ensure the long-term sustainability and stability of their operations. As the financial markets and regulatory landscapes it continues to evolve, ALM always remains a critical tool for the institutions seeking to adapt and grow in an ever-changing financial landscape. Coming to the next topic, that is the objectives of a ALM. ALM leads to a formulation of the critical business policies, which is for efficient allocation of capital and the designing of products with the appropriate principal strategies. So the main objectives of the ALM are the price matching, the risk mitigation, profitability optimization, and the liquidity matching. So what is a price matching? Price matching basically aims to maintain the spreads by ensuring that the deployment of liabilities will be at a rate higher than that of the cost. So this exercise would indicate whether the institution is in a position to benefit from the rising interest rates by having a positive gap, that is assets are always greater than that of the liabilities, or whether it is in a position to benefit from the declining interest rates by having a negative gap wherein the liabilities are always greater than that of the assets. So how does it what is risk mitigation in the case of as an objective in ALM? It identifies and manages the interest rate risk, the liquidity risk, and the market risk to ensure the financial stability of a financial institution. Coming to coming to the profitability optimization, it maximizes the return on assets while controlling the cost of liabilities, aim for the sustained profitability of any banks or any financial institution. The liquidity and management. In the case of liquidity and management, the ALM ensures the availability of funds to meet the obligations while maintaining a balance between the short term and the long term assets. So, with that, we come to the end of this session. We will start off with the next session, that is the capital adequacy of the Basel norms. If you have any questions or comments, please feel free to leave them in the comment section. Your feedback is very valuable to us. And do not forget to like, share, and subscribe our channel, The Brilliant Bankers. Until next time, this is Nishan signing off, wishing you a great day. Jai Hind.